An oil crisis isn't why your tech stocks are falling. At least, not directly. The real chain reaction starts thousands of miles away, moves through global shipping routes, hits inflation, pushes bond yields higher, and only then reaches companies like Nvidia and Apple. To understand why your portfolio is crashing, we have to look at the geopolitics of supply chains. What happened in the past few days isn't a delay. It's the collapse of the one safety net that kept this market afloat all summer. Here is how. The global oil market has one major vulnerability. Most people think it's the Strait of Hormuz. They're only half right. Before this week's escalation, roughly 20% of the world's daily oil supply moved through Hormuz. Another 4% passed through the Bab el-Mandeb Strait in the Red Sea, while the Black Sea handled another 2 to 3%.
When tensions escalated in the Persian Gulf and around 14.3% of global oil flows became trapped with no direct alternative, many expected oil markets to spiral. But they didn't. Why? Because Saudi Arabia had already built a backup route. Instead of sending that oil through Hormuz, it redirected millions of barrels across the country using pipelines to the Yanbu terminal on the Red Sea. It pushed transit through Bab el-Mandeb from 4% up to 7%, and for a few days, it worked. Then this week, Yemen entered the picture. Houthi forces of Yemen are now hitting the exact route Saudi Arabia's backup oil depends on. 4 to 5% of that rerouted supply is delayed or gone, forced into a detour around the entire African continent. And up north, it gets worse. Drone strikes in the Black Sea have knocked out another 1 to 1.5% of global supply. Added up, trapped Gulf oil, a disrupted African detour, and a Black Sea under drone fire. That's not one blocked strait anymore. That's nearly 20% of the entire world's oil supply actively disrupted, at the exact moment the U.S. Strategic Petroleum Reserve sits at levels not seen since 1983. There is no emergency cushion left. None. And that physical bottleneck is already starting to break specific sectors of the market. Let's start with the obvious blood in the water: airlines and logistics. Delta, United, American, all getting crushed. And it's not complicated. Jet fuel is their single biggest expense. Trap a fifth of the world's oil, and fuel doesn't creep up, it spikes overnight. Airlines can't raise ticket prices fast enough to cover it. Margins don't shrink, they vanish. But that's the obvious story. Here's the one your portfolio actually needs to hear. Why are Apple, Nvidia, and Microsoft getting hammered by an oil crisis? They don't care about the price of gas. They care about something far more dangerous to a tech stock: bond yields. Tech valuations are built on a promise of massive earnings years from now. But a 20% oil shock guarantees inflation stays hot, which means the Fed can't cut rates. Rates stay high, yields spike, and suddenly a Wall Street fund manager can lock in a guaranteed 5% return from the US government risk-free. So they take the money out of your growth stocks and park it in bonds. That's the rotation. That's why the NASDAQ is bleeding out over a war in a strait most people couldn't find on a map.
So if the obvious names are bleeding, where's the smart money actually hiding? First, U.S. domestic drillers. With Middle Eastern oil physically trapped, producers pulling crude straight out of the Permian Basin, names like Occidental Petroleum and EOG Resources, suddenly look a lot more valuable. Their oil doesn't have to sail through a war zone to reach a buyer. Second, and this is the one almost nobody's talking about, the tanker trade. Remember that 4 to 5% of oil Yemen just forced off its normal route? It now has to sail all the way around the southern tip of Africa. That's not a shortcut. That's weeks added to every single voyage. And when ships are stuck at sea for weeks longer than planned, something happens fast. The global supply of available tankers collapses. Companies that own those fleets, Frontline, Scorpio Tankers, can suddenly charge daily rates that would have sounded insane a month ago. While the rest of the market bleeds out, these companies are printing cash. The biggest mistake investors make during geopolitical crises is watching only the headlines. The market is watching something much more important: oil routes, bond yields, shipping rates. Those are the signals that determine where money flows next. As long as these supply disruptions persist, higher energy prices could continue to pressure inflation and keep rate expectations elevated, creating headwinds for growth stocks while supporting parts of the energy and shipping sectors. Comment down below which stocks you think will be the biggest winners or losers from this global oil crisis. And if you found this breakdown useful, subscribe to the Bull Run Project for data-driven market analysis that goes beyond the headlines. I'll see you in the next one.